Hey everyone, welcome to New Market Review. I won't be around this weekend, so doing the video now. So market kept going up higher. I got some puts yesterday, not a lot, just like a couple of contracts yesterday when we hit 7,500, like I said. And I do not believe in this rally continuing, like I explained. I could be wrong, but I don't care. I went cash, like 90% cash, and I will stick to that for the next 2 weeks at the minimum. So my logic is as follows. Aside from, I'll go into other stuff, but I'll start with the logic of the trade. The logic of the trade is as follows. If we get the de-escalation in Hormuz, uh, then oil will drop. If oil drops, energy names will drop. So maybe like something like this in XOP or in XOM, we go down. Sorry, like this. Again, we get this type of trade going on. And I will buy the dip in energy. If we actually get a correction that goes a long way, we get this type of pullback to the 21 EMA. It's 5, 6%, 7%, 8%. I don't know. It's to be assessed while it is happening. Uh, but then we will get names like Microsoft doing maybe this, going to like 380, 390, and buy the dip in that. Maybe Bitcoin maybe does this, and again we buy the dip in that. Maybe momentum names like ARM does this, Qualcomm this, MU this to the 21 EMA, maybe a slightly higher. But you get the idea. So the the point of this trade is for the next 2 weeks, do nothing, wait and see, get the fuck out of the way. And we will get a dip in something. When things play out and become more clear, we buy the dip in the thing that corrected and go from there. Now, the thesis remains strong in my opinion. VIX has continued to stay higher. We have a higher low here. We have a trend. We'll see if that sticks. Market starting opening pretty low yesterday after the pump. Pretty low today after the pump yesterday. Again, we'll see if that sticks. I wouldn't be surprised if it recovers anyway. But the week has been pretty horrible for macro data. We got inflation data and it was bad. 3.8 for headline and 6 for PPI, and things point to this going even higher. Nowcasting, generally speaking, gets it right when we are stable, but when we get acceleration, they tend to underestimate. For example, this week, the expectation was 3.56 and we got the 3.8. So 0.25 miss on the uh, forecast. And this, from personal observation, they tend to get it wrong when we get acceleration, either up or down. For example, this is an example of getting it wrong when we are accelerating up. They underestimate, but the same thing happened when we were going down. And if we were accelerating down, the estimate would have been 3.6, but we would have gotten like 3.4 or 3.3, something like this. And the forecast for next month is 4.17. So there's a good chance we get a 4.3 headline, 4.4 headline, which is huge. Other than that, inflation data for Asia was very, very bad. We got headlines from India with the reduction of imports of gold, work from home, use less petrol. Yesterday they banned the exports of sugar. So the real world impact for Hormuz is happening, and it will accelerate and it will broaden. This is not compatible, in my opinion, with the market going up. Brent has been going down as well. Slight recovery yesterday, but very, very small. McLaren oscillator is sometimes stupid. I would trust oops, this one more, which is the sector breadth added up, and it barely moved. When we look at percentage of stock above the 20 moving average, again, barely moved up yesterday, we are only 43% of stock, the entire stock is in the market on the New York Stock Exchange, are above the 20 moving average, while the market is making new highs. We also got a new record for stuff like market at all-time highs and percentage of stock in the S&P 500 making new 52-week lows at 8.5%. So on Thursday, no, on Wednesday here, market made new all-time highs, and 8.5% of S&P constituents were making 52-week lows. That was a new record. The previous one was like 6.5, something like that. Then we have yields moving higher, making new highs above 5%. 10-year also moving higher. 2-year moving higher. And remember when people were crying about, let's do the simpler chart. Remember where people were crying that the Fed is not cutting because the 2-year is saying that the Fed should be cutting? Right now, the 2-year is saying the Fed should be hiking. And most likely it will go up to here. We are above the Fed funds rate with inflation for the first time since this cutting, since we went under. So, like in the past 3 years or so. And we are getting acceleration in yields and breakouts in yields. If you remember for a while back when I posted a crazy scenario for the 10-year going here, this is a delusional Fed scenario. Like I don't think it's going to happen, but if the new Fed chair insists on cutting rates, given what is happening, the bond market will tantrum like crazy and it will crash everything, and we will actually get this. We'll see if it happens. Also, historically speaking, SPX, when a new Fed chair comes in, they get tested. This is J Powell. This is when J Powell joined the not joined the Fed, became the FOMC chair, and it was a minus 4% day on SPX and during a correction. Also with a melt up before that, that lasted until month turn, and then it started going downhill very 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 fast. And like I said, new fetchers tend to get tested by the market and see how they react. This is nothing not related to the fetcher. This was Yellen, and again, market going up and then went downhill afterwards. Then we have Bernanke, I think. Also a smallish correction afterwards, but then a bigger one later on. And we had only four Fed chairs in the past 40 years. This was, I don't know, Greenspan. And again, market super rallying ahead of the Fed chair, and then correction, and then 87 crash coming up. I'm not saying that this will happen, but this was a freak event. But I think it would have gone down. The problem with this one is it's not natural, so it would have gone down maybe to this in without the minus 20% day here. This one is unnatural. So this would have been the threshold for the crash in normal circumstances. So we're getting a new Fed chair. We're getting higher inflation. The jobs market is stable. Like we got jobs data, a small spike in continuous claims, but nothing scary about this at all. We should be getting lower unemployment moving forward. So jobs market stable, inflation coming in hot and likely accelerating, and the market does this. What the fuck are you thinking? Then the final piece of the cake is DXY going higher. DXY is above all moving averages. It went above the 200 moving average once again. Today is going above the 50 moving average. We are above the ribbon. We are above the yearly open. We have a falling wedge breakout. It looks bullish as fuck. So all of this coming together to say that we are likely going down. Uh, Again, I could be wrong. What is happening in the market is relatively unprecedented. Comparisons to the 2000 bubble are right, but they are also wrong. When we were in this is the bubble, and inflation wasn't really screaming going higher. I mean, it was stabilizing. It went up to kind of the same level as here, but The macro situation was not similar at all in the 2000 bubble. There were no risks like we have now. So I don't believe we will get a bubble play out. I think it's more likely we correct and we go sideways. Like we created a range. Think of this as an extended range. I think it's more likely that we do something like this than the bubble expanding and going higher. So that's kind of the setup. I explained my thought process about buying the dip. I'll recap it. Stay away from the next 2 weeks and see what happens. We will either get an opportunity to buy the dip in energy, which I think is going to be a good dip buy because earnings will remain elevated for the foreseeable future because of high oil prices, or we will get to buy the dip in the momentum stocks that are going higher. But the risk is that if this rally begins, it will have a very fast unwind and it will overshoot the expected levels. Like let's take US 100. I think it's more likely that we go like all the way here, which is, let's see, 8%, 9%, or even to the AVR from the year start, which is 14%, then that this is a quick one that goes only 5. The people will expect it's a 5% correction. It will more likely be a 8, 10, with the potential to go even higher and build the range for this. I don't know for sure. But I would rather err on the side of caution, protect gains, and when we get another opportunity to go big, I will choose to go big then, and we'll see. So that's the reasoning, that's the setup. Have a good one. Bye bye.